inflation sneaking up and surprising them, because the Fed never made a forecast of inflation. They literally were flying blind. I mean, they did not know what's going on. If you're flying an airplane and the altimeter doesn't include the money supply, you've got a big problem.
Welcome to the Rose Show podcast. Thank you so much for joining us today. I have the highest honor of being here with Steve Hanke, professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University. He's the former economic advisor to President Ronald Reagan, currency and commodities trainer, and also known as the money doctor. The list goes on, so I'll stop right there. So how are you doing today, Professor Hanke?
Doing very well, Rosanna. Great to be with you.
Thank you. So grateful to have you here. How was Istanbul?
Istanbul was better than ever.
Well, we'll definitely talk.
It's always pretty good. But Mrs. Hanke and I had a great trip, and we did exactly what we wanted to do.
Wonderful. Well, we'll talk about the global economics in a little bit, but I'd like to start with the theme of the 95% rule. 95% of what we read in the press is usually wrong or unreliable. So, Professor, I'd like to start with asking you, please give us the reality of where we are right now with the U.S. economy and our economic landscape, with all this money shrinking, the Fed looking at lagging data, and everyone's so focused on interest rates when everyone knows that inflation is always and everywhere a monetary phenomenon.
Well, back to the press of today and my 95% rule. The press is filled with stories about the non-monetary causes of inflation. I just looked at the Financial Times today, and it's filled with stories. They're all stories about all these ad hoc kind of anomalous causes or alleged causes of inflation. And as you indicated, inflation is always and everywhere a monetary phenomenon. It's not a non-monetary phenomenon. So what is this? I mean, how do we deal with this? Well, changes in the money supply cause, with a lag, and this is always a tricky thing, with a lag of about 1 to 9 months, asset prices and sensitive commodity prices start changing. So if you get an explosion in the money supply like we had in 2020, 2021, with a lag of about 1 to 9 months, what happened? Well, asset prices went up, the stock market boomed, real estate went up, all the commodity prices started shooting up. And then with another lag of about 6 to 18 months, the real economy starts cranking up or changing. And that, of course, happened also after the explosion in the money supply that we had in 2020, 2021. And then eventually, with a lag of about 12 to 24 months, inflation, generalized inflation starts picking up. And of course, it picked up a lot because to hit the inflation target of 2%, the Fed should be growing the money supply measured by M2 by about 6% per year. And at the peak, it was growing at about 22, 23%. We haven't seen that kind of rate of growth in the money supply since World War II. So, of course, growing 3 times faster than what I call the golden growth rate, that rate consistent with hitting a 2% inflation target, we got inflation. And using the quantity theory of money, and which is a monetarist idea, John Greenwood and I anticipated and wrote about this in the Wall Street Journal, that inflation, we said, would be between 6 and we said maybe as high as 9%. Well, it did peak out at 9.1%. in July of 2021. So that was a bullseye. That was a hit. Now using the same kind of thinking that somehow changes in the money supply affect asset prices, sensitive commodity prices, economic activity, and inflation. What we've had is a contraction, a huge contraction in the money supply. First, the Fed hits the accelerator as fast as they can, puts the thing at the floorboard, and now they've put the car in reverse, and the money supply since last April has actually declined by 4.6%. So this has not happened, by the way, since 1938-39. That's the last time we've seen that kind of a contraction in the money supply. So again, using the same quantity theory of money model, Greenwood and I have projected in February, we projected that by the end of this year, inflation would be down at between 2 and 5%. Well, now the new headline inflation number just came out this week is 4%. The producer price index, by the way, is falling. That came out this week. It's only at 1%. So inflation is a story for yesterday, not today, but you wouldn't know it from reading the papers. They're still whining around about inflation and all kinds of non-monetary causes of inflation. If you read the paper, they're not talking about what I'm talking about. No one's mentioning the money supply and the fact that changes in the money supply affect ultimately with a fairly long lag of 12 to 24 months, it starts affecting inflation. So that's the inflation picture. It's coming down, and I think will be probably on the low end of our forecast range for the end of the year. The range, remember, was 2 to 5%. It's already at 4%. I think it'll continue to nudge down and be probably closer to 2 than 5 by the time we end the year. The problem is one thing in the transmission mechanism. Remember, first thing, asset prices start changing, then economic activity starts changing, and then inflation starts changing. And real economic activity with this kind of contraction in the money supply, Rosanna, will see a recession coming probably by the first quarter of next year. And if the Fed keeps doing what it's doing, if they continue in this reversal that they're in, it could be a pretty ugly recession.
Sounds like
so that's the U.S. picture. So you have to keep your eye on the money supply. That's what really counts. And it's a little bit tricky to deal with because you've got all these lags between various things going on in the economy and changes in the money supply. So if you look at the economy today, you get a better idea of what's going on if you look back a year or maybe a year and a half at what was going on with the money supply back then, not what's going on right now.
Got it. Thank you so much for all that. Now, there's so many points in there that I'd love to go over, but I think we'll start with why. Why did the Fed overlook the money supply? Is there a reason why they don't focus on that?
Well, the biggest reason is that the models that they have are post-Keynesian models that don't include the money supply. So if you have a model of something and it excludes the key variable, you've got problems. So they have 785 economists in the Federal Reserve System, and none of them was able to predict inflation. Remember Team Transitory. This was just a transitory thing.
Yes.
It's going to be over. There are all these oddball things going on. So remember the supply chain shocks and the oil shock.
Cost push inflation.
Yeah, and we had even Putin's inflation with the war in Ukraine, and you name it, it goes on and on and on. So those were the non-monetary reasons they gave, and for made a forecast of inflation. They literally were flying blind. I mean, they did not know what's going on. If you're flying an airplane and the altimeter doesn't include the money supply, you've got a big problem. Well, their altimeter doesn't include the money supply, and they have explicitly said this. Chairman Powell, chairman of the Federal Reserve, has said repeatedly in testimony that they don't look at the money supply, and he claims that's because it's an unreliable indicator of what's happening to the economy and economic activity and inflation. And so, and he's basically just doubled down over and over again with that idea. So they have really canceled the quantity theory of money, monetarism. That's passe. That's out the window.
Well, with their current plan and what they're doing with QT, as well as the credit crunch we having with the supply and demand, huge decreases in lending, what do you foresee with the current trajectory of the shrinking of the money supply? And are we at past the point of no return, that the recession is imminent for the first quarter of next year? And can the Fed do anything at this point to stop or slow it down or minimize that recession?
Well, the recession really is baked in the cake, because what's happened in the past to the money supply and the shrinkage of the money supply, that's already happened. So that's why I say baked in the cake.
Mm-hmm.
With this lag of 6 to 18 months, you look at the peak of the money supply growth was in July of last year. So we're like the 11-month mark right now. So we're right in this zone of 6 to 18 months before real economic activity starts changing fairly rapidly. So that part is baked in the cake. What they could do, and I think should do, is they try to alter monetary policy so that they would get the money supply growing at about 6% per year, instead of contracting it 4.6% per year. It should be growing at about 6% per year. That would mitigate shall we say, the damage. We would probably end up with a mild recession then. However, I don't think it's in the cards that the Fed's going to be changing. They're not going to be changing the models they have. They're not going to be changing the way they're thinking. They're not going to be changing the 785 economists at the Fed. And that means quantitative tightening, which you mentioned, will continue, shrinking the balance sheet of the Federal Reserve, and actually not contributing to the growth in the money supply. They're actually subtracting from it with quantitative tightening. And in addition to that, although yesterday they didn't change the federal funds rate, the Chairman Powell indicated that they anticipated that they would be increasing the federal funds rate probably in the July Federal Open Market Committee meeting that they're having. So I think they'll stay on course, unless there's one proviso, and that is that there would be a serious credit crunch on Wall Street that riled the markets tremendously. And the Fed is data dependent. They watch the day-to-day data. And if there was an upheaval on Wall Street and a big credit crunch hit, I think they would pivot then and start loosening up. But I don't think, absent that kind of a crunch, that they will change until it's way, way too late.
Yes, unfortunately. I want to go into the point about the money supply is actually created by the private sector and the banks. And I love when you talk about how About 85% is created by the banks and not the Fed. And I think that's when the 95% rule comes in again, because most people think it's the Fed that only creates the money supply.
Right. So this is an important point, that money held by the public, this broad measure of the money supply, M2, literally 82.5% of that right now has been contributed by commercial banks. Now, commercial banks create money, and they create it when they make loans and extend credit. So if they make you a loan, Rosanna, what happens? Your checking account goes up.
Yeah.
And that counts as part of the money supply. That's money. And so that's what's happening. And the elephant in the room are commercial banks. This is the most important part. The Fed does contribute to the money supply growth with increased reserves that they're holding and currency that's outstanding, notes and coins, that kind of thing. But that's a fairly small amount of the money supply. Now, to think about this and the importance of it is that right now we've got quantitative tightening occurring. So the Fed's not putting anything in the monetary bathtub. They're actually sucking money out of the system. So the question is, who's contributing? Who's making a positive contribution to the money supply? And it has been commercial banks, but that's been slowing down very rapidly. And after the Silicon Valley Bank and the other two banks went under, that slowed even more, because the government regulators want to enforce regulations more rigorously, shall we say. They're trying to encourage these mid-sized banks to increase the capital asset ratios that they have, recapitalize the banks. And to do that, you can increase the capital asset ratio one of two ways. You can increase it by increasing the numerator, capital, but that means what? You've got to, in most cases, issue new stock. Well, people don't want to do that. Banks don't want to do that because the existing shareholders get diluted, and so that isn't really very attractive for most banks. So you have to go to the denominator, the assets, and you have to do what? You have to shrink them to increase the that increases the capital asset ratio also. Now, how do you do that? Well, you don't make loans, or you don't roll over old loans that you have. You start pulling in your horns. And that's what we're seeing in the credit market right now. So the credit being issued by banks and the bank's contribution to the money supply has been slowing down very rapidly. So that, on top of the QT that the Fed is engaged in, that's why you get this negative number of minus 4.6% in money supply growth year over year, a number we haven't seen since the late 1930s. So that's what's going on with the money supply, and as I say, the Fed is just ignoring it. I mean, and they advertise that they're ignoring it. When you listen to Chairman Powell yesterday talking about the results of the Open Market Committee and the fact that they weren't going to change the federal funds rate, you heard him talking about interest rates. You didn't hear him talking about the money supply.
Absolutely right. He talked about interest rates, and then they're so focused on the job market as well. When, like you've said before, jobs don't start getting cut until we're into a recession, not before the recession.
Right. Those are what we call, Rosanna, a lagging indicator, and it's again basically looking in the rearview mirror. The Fed's very data dependent, so they look at current data and the job market data. Anything connected with the job market is very important for the Fed, but that is a lagging indicator. So that's one lagging indicator. The other lagging indicator, they look at prices. But the price index that they look at is called a core price index. And what the core price index, it isn't the consumer price index, a headline inflation number. It's a number in which the extreme and more volatile aspects of what's in the broader price index is taken out. They take these volatile commodity prices, for example, out. And when they do that, they get what's basically a lagging indicator, because if you take prices called wholesale prices or producer prices, those start changing before the consumer price index does. And the consumer price index, it leads the core index. So if you look at inflation, when it started, the first thing that went up were the wholesale prices and producer prices. And then the next thing that started going up, the headline numbers started going up. And the last thing actually that went up was the core, because it had all this stuff trimmed out. And coming down, you're seeing exactly the same thing. The wholesale and producer prices, they go down first, then the consumer price, it's going down. Remember, it peaked at 9.1%. Now it's only 4%. And the producer prices, I said, now they're only 1% year over year. So the inflation has been really wrung out of those. Now, why does this pattern exist? It exists because wholesale and producer prices are prices determined in what we call the spot market. That's things are exchanged not on long-term contracts, but they're bought and sold today and priced today. You know, corn, commodities, oil, all of those things. So they react much more rapidly to changes in the money supply than do other prices that are more sticky, that are maybe in longer term contracts. Or like a restaurant, does a restaurant change its price every day? Well, if you're in a hyperinflating country like Venezuela, or Venezuela actually isn't hyperinflating. The only country that's hyperinflating right now, where the inflation rate's over 50% per month, Zimbabwe. So in a place like Zimbabwe, they change the price on the menu, or the grocery stores change their prices every day. They're changing so fast. And that's what you find when you start looking at the wholesale prices, or what we call producer prices. So what's the Fed looking at? They're looking at the last thing that's changing, which is this core inflation number.
Got it.
So they're behind the curve when they're looking at the labor market and the economy. That's kind of the last thing to start really changing.
Exactly.
And as you said, if you get into people don't lay off people in anticipation of a recession. They lay off workers after the recession sets in and after they start losing money and getting squeezed, because you don't want to lose your labor force. You've trained people. You've got a lot invested in them. You don't want to let them go, unless if you're forced to. I mean, all of a sudden, if your free cash flow goes negative on you, and the bankers are banging on your door and everything else, you start trimming your labor force. Then you don't do it in anticipation of maybe bad times.
Absolutely right. You do, and you have to. You've invested time and effort and money into those workers. That's until you have to let them go. And that is the recession that you speak about. Now, this baked-in recession that's looking to be early 2024, based on all these factors you discussed and what's baked in, do you believe it will be a severe, deep recession? And how long do you anticipate, based on these lagging factors, that it will last?
Well, if it's hard to tell because it does depend on what the Fed does. Now, if the Fed does not pivot and they continue with quantitative tightening, and they continue contracting, setting in place policies that lead to continued contraction of the money supply, the recession will be deeper and it'll last longer. That's really all I can say. I can't give you a date how long it's going to last because we don't exactly know what the Fed's going to do. But it looks like they will continue with this squeezing and tightening thing. And if that's the case, I anticipate we'll have a fairly ugly recession and one that's going to drag on. The Fed is just late to the party because they have not anticipated the inflation. They have not been able to forecast where the economy is going because they have all these wrong, ill-defined post-Keynesian models instead of using the quantity theory of money. So they're just basically flying the plane in a blind way, or looking in the rearview mirror. You can use all kinds of metaphors and analogies to come up with a thing, but it's pretty shocking, actually. And if you look at what they're talking about now, what are they talking about? Inflation is falling like a stone. That was yesterday's story, and we know that if you apply the quantity theory of money, you know inflation was yesterday's story. They're talking like it's persistent. It's a big problem. We know, Powell was saying yesterday, it's a nasty problem. It's going to take us time to get it wrung out of the system, and we'll probably end up having to increase the federal funds rate one more and maybe even two more times.
Exactly. Now, I want to talk about your golden growth rate and how you estimate that the money supply should actually be increasing at about 6%. And right now it's shrinking at the fastest rate since the 30s at like a negative rate. So please tell us about that formula.
Okay, so the formula is what they call it's an identity, actually, an accounting identity. M is the money supply, V is velocity of money, P is the price level, and Y is real economic activity. So MV equals PY. That's the equation of exchange. And if you do a little manipulation with the thing and solve for M, what you want to do is you set M equals P plus Y minus V, because you've taken the V from the left-hand side of that identity and put it over in the right-hand side. So the numbers for the US are roughly, we know what P is. P is 2%. That's the inflation target. So put a 2 in for P, and Y is the potential growth rate, or what roughly what the potential is in the United States. That's about 2%, a little over 2%. Just put a 2 in there, and the velocity of money, and the velocity is simply given by P times Y over M. The velocity is about 2 minus 2 minus 2, and I said we have P plus Y minus V, and a minus is a plus, so you end up with a plus 2. So you have 2 plus 2 plus 2 is 6. So that's how you solve the golden growth rate.
Got it.
And it's pretty close, roughly around 6%. Actually, if you really look at the real numbers, it's 6.26%, but it doesn't really make much difference to 0.26. We're not going to argue about 0.26. Yeah. roughly about, let us say, between 5 and 6%. Normally 5 to 6% would get the Fed in a position where they would be hitting their inflation target at 2%. And that's roughly, by the way, what we had in all those years, when Alan Greenspan was chairman of the Fed, that's more or less what the growth rate of the money supply was.
Yes.
So if you look back at where we were and how close we were to hitting the inflation target for a long time before the pandemic hit in February of 2020, the money supply was growing, more or less between 5.5% and 6.5%.
Perfect. You simplify it, so make it seem so easy. It's so simple. It seems like it all makes sense. And thank you for that, for explaining that. Now, what would you do, Professor, if you were the Fed chair right now? What would you do?
Well, I'd stop quantitative tightening, and obviously I'd leave the Fed funds rate where the Fed funds rate is. I wouldn't fool with that, but stop quantitative tightening and set in place policies that got that M2 money supply growth number up to around 5 or 6%. That's the pivot that you want to make. And by the way, one thing to do that, we were talking about commercial banks earlier, is that you don't want to squeeze the commercial banks, which they're doing right now. With the regulators are squeezing the commercial banks and causing them to be more stingy with credit. And when they're more stingy with credit, increasing these capital asset ratios that I talked about earlier, that makes the contribution of the commercial banks slow down. And in fact, it's slowing to the point where it's almost zero. The credit growth is slowed dramatically from around 11%, 12% year over year to something like 3%. It's been coming down very, very rapidly. So you don't want that kind of excessive regulation on the banks. That's what we call a pro-cyclical bank regulatory policy. It's the same kind of thing we had after 2008, the crisis in 2008. Remember the Dodd-Frank bill?
Yes, absolutely.
Came in and started strangling the banks, and the banks actually in 2008 they actually were making a negative contribution to the money supply. So they weren't making this big. They were the elephant in the room, by the way. They were making a negative contribution, and that really forced the Fed to start quantitative easing to mitigate the damage that the Dodd-Frank legislation was doing. And at the same time, you had something else in the pipeline, what they call a Basel III capital requirements. They were being put on banks at the same time. So you had kind of a double whammy on the commercial banks that actually ended up with commercial banks making a negative contribution. Credit was actually contracting. I mean, it was in the negative area for a while, and that's why the Fed was forced to do quantitative easing and expand their balance sheet so much. And a lot of people got this all wrong. They said, "Oh, we're going to have a huge inflation because the Fed is expanding its balance sheet, doubling the size of its balance sheet." Remember that all of that in the press. We're going to have big inflation because of the Fed. Well, they forgot the elephant in the room was contracting. That was the commercial banks, and that was because of the regulators. So you had not a counter-cyclical monetary policy going on with the bank regulations. It was a pro-cyclical. We had a recession starting after the crisis in 2008, and what happened with the banks? The banks were being regulated and strangled, and they weren't contributing to the money supply. They were subtracting from it. That's what's called pro-cyclical. They were making the slowdown worse, not counter cyclical, not making it better.
Exactly right. Well said. Thank you so much. What about all this mass government spending? The debt now, I think, is 32 trillion. And where does this all go? How does this all end? Is it just going to continue? And how do we overcome this?
Well, the debt, if you look at the Congressional Budget Office and their projections, that the debt to GDP ratio just keeps going up in the United States. In other words, the things are set up now, so it's really unsustainable. It's just going up, 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 up.
Exactly right.
Unless something has changed. So what I think they should do is stop talking about debt ceilings and all this kind of thing, and make a change in the rules of the game and put in something that's called the Swiss debt break. The Swiss actually changed their constitution in a national referendum, and they have a system in which the government expenditures can't increase any more rapidly than the rate of growth in the economy, and they must balance the budget in Switzerland over the medium term. So not only the growth in the government spending can't exceed the growth rate in the economy, and also they can't run deficits to finance the government spending that's being capped by the break. So that's the kind of thing we should have, but that's not what they're talking about.
No, exactly right. But that's what's concerning, is that they're not doing those policies. And so at some point, it seems that something has to break. And will they finally wake up? Do you think anything like that could occur? Or how do you think this could end?
Well, if something, there's an economist, actually a fairly well-known economist, the late Herbert Stein. Herb Stein said, if something is unsustainable and it can't go on, it will stop. And we can see from these projections by the Congressional Budget Office that it can't go on. I mean, the debt to GDP, it can't go on forever. So that means it will stop. The question is, how will it stop?
Yes.
And that we don't know. I told you my preferred solution to stopping it was be a Swiss type debt break.
Exactly. Well, Money Doctor, I love that. I love your solution. I wish they would listen to you. I want to ask you, who gave you the name Money Doctor?
I don't really know. These things happen kind of spontaneously. Who knows? Probably some journalist did.
I guess it's stuck.
I don't really know, but at any rate,
I want to ask you about.
It is an actor. I think the source of it, kind of generically, is that I've been engaged in a number of currency reforms, successful big currency reforms that have smashed hyperinflations and stabilized economies. And in the past, there were other economists a long time ago. All these economists are unfortunately not with us any longer, but they had done reforms, especially after World War One. And those, the attribution that was given to those currency reformers was the money doctors, and so that's probably where it came from. So I'm kind of a modern version, I guess, of those guys.
Well, we're so grateful to have you. Thank you so much. I want to know your thoughts on the markets, the financial markets right now. They're running like they're just, everything's fine and everything's great and we're expanding and everything's improving. What are your thoughts on what's going on over there?
Well, number one, if at 30,000 feet, it does look like everything is going gangbusters and no one's worried about anything. But if you go down to a little lower altitude, they're actually, the breadth of the market is not very good. There are just a few stocks that are pulling these indices up. So the indices look pretty good. But if you look at what's going on, you have very few stocks really driving it up. I think when the recession hits, we will see some adjustments in the price earnings ratios. The markets will come down. Also, if you look at earnings as a percent of GDP, that's been coming down.
Mm-hmm.
So earnings margins are being squeezed already.
Of course, yes.
Already margins are being squeezed, and when the kind of headline GDP starts dropping and sales start dropping, that's kind of a deadly cocktail. Your sales, your top line revenue is going to be going down, and at the same time your margins are getting squeezed. So you'll have a pretty good hit on profits, and I think the PEs will adjust to the downside. So we'll enter probably some sort of bear market overall. But there are certain things like gold always does pretty well going into a recession. So I think gold will,
absolutely, I agree.
Probably keep a little bit of gold in your sock and you'll be okay.
Agree.
And then the usual thing, good companies, selected ones, are going to be, fine.
But exactly, cash and free cash flow yields. I know, I agree. Margins are compressed, and to me, the market's expensive. PE should be coming down. Equity risk premium is the narrowest it's been, I think, since pre-GFC. When risk-free rates are over 5%, I mean, T-bills look great as a safe haven, safe investment there. And I agree, gold is very important to have as part of the asset allocation of portfolios. And I know you have this really awesome gold sentiment index that I want to ask you about. I want you to tell us about that.
Okay, so Rosanna, Abe-Coughness and I developed the Hanky-Coughness Gold Sentiment Index, and what that is, it's a measure of market sentiment, and it's the only measure like this that we're aware of. What we do is we text mine. We with the use obviously of computers, every hour, each story that comes out about gold, we mine that, we text mine those articles to see whether there are words in there that are bullish or bearish. So we then aggregate all of those things, and every hour, this is very high frequency data, hourly data. So we come out with what the sentiment is in the market. And what happens, I think the easiest way to think about it is let us assume that the gold market is just flat for a year. The price at the beginning of the year and end of the year are exactly the same. What the sentiment index allows you to do is the sentiment isn't going to be flat over the year, and the price isn't going to be flat over the year. It'll fluctuate around this level line. And the sentiment index, what that does is it measures the sentiment every hour. And let's say the sentiment gets very bullish. What we do to trade off of that, if the sentiment gets very bullish, we know that the sentiment will revert back to a neutral position, maybe even swing over to a bearish position. So if it's very bullish sentiment that we're getting, you want to liquidate your long position or take an outright short position. If it's, on the other hand, if it's very bearish, you want to liquidate your short position, or maybe even take a long position because the sentiment's going to swing back the other way. So the sentiment score comes out, and you've got to hook an algorithm up to be trading off of that, and which we've done. And depending on the trading algorithm that we have, we've been over the last year, a little over a year, we've been running at rates of return like 30 to 50%. So So the overall market doesn't have to be changing 30 to 50%, but all the fluctuations, you're picking up the fluctuations and trading on with a high frequency data, you can do it, but you might be in and out of the market 2 or 3 times a day.
Wow, I love that. It takes
like I think the last time I looked, I think the average duration of a position that we had was like 13 hours.
Oh wow.
So this is very, very short term kind of trading. So that's what the Hanky-Coughness gold sentiment index is, and you can get that by just going to www.thegoldsentimentreport.com.
Perfect. And I'm going to put that in the description for everyone. Thegoldsentimentreport.com. I urge everyone to check it out. See, it takes like an aggregate barometer or temperature of gold. It's like it's just amazing. I love how you have that, how it's a text mining. And then it's always like a reversion to the mean. When it gets too bullish, it comes back bearish, and then vice versa. Brilliant, very smart. I like that a lot. Yeah, fundamentals matter, quality. More than ever. We're not in that free market negative rate time period that we've been in. And I think fundamentals always should matter. Money doctor, if you don't want me calling you that, professor, I'd like to know your thoughts on currency. And there's so much talk, and I want to bring truth and reality here. There's talk about the US dollar as the global reserve currency. My opinion is there's no real contender, and it should remain that way. What are your thoughts on the global landscape with currencies? I know you also trade currencies, and if you could just shed some light in that arena for us, please.
Well, the U.S. dollar, you see a lot of press about it's almost constant every day about de-dollarization.
Oh yeah,
as they call it, getting out of the dollar and using going to some substitute. So it turns out that the dollar is the international currency, and if you look back, there have been very few international currencies. There's always one, by the way, always. So if you go back to the 7th century BC, there have only been 14. So they don't change very rapidly, and the U.S. dollar happens to be the international currency right now. Unfortunately, the United States really, in a way, since 9/11, but it's been accelerated a lot in the last few years. The U.S. is kind of weaponized the U.S. dollar because they put sanctions on people or countries, and this is a problem for the U.S. dollar, or a potential problem for the U.S. dollar. So that's one reason there's so much talk about this de-dollarization. But the reality is not much has changed, even though I think the dollar is more vulnerable than in the long run than it would have to be if it wasn't weaponized, and if we weren't using these ill-advised sanctions that never work anyway. But the most important exchange rate price is the dollar-euro exchange rate. And I think the fair value of that exchange rate, it's about 120 to 140, something like that. The dollar now is about 108. It's very strong. So if you look at the dollar euro exchange rate, the dollar is extremely strong. It's been extremely strong for some time, and I think it will stay extremely strong through this recession kind of scenario that we're painting. So that's it on the dollar, right? The dollar is not going any place. It's not going to be de-dollarized in any significant way, and it happens to be trading very, very strongly right now.
Mm-hmm.
I think it's outside. It's what I consider the fair value, 120 to 140. It's down about 108. It's on very much the strong side. So that's pretty much it on the dollar.
Thank you. Now, speaking about the global, we know inflation is a local problem. And so let's talk about the global issues that we have. I know the sanctions inhibit growth and it's just a disaster, for it's anti-free trade. And so what do you see going on in the landscape with that, as well as all this debt to the IMF, Argentina, Ecuador, Colombia? What do you see going on in all that, please?
Well, that's a big problem especially for a lot of emerging countries, emerging market countries, and particularly the ones that get tied up with the IMF, because they really get buried in debt. And the IMF programs themselves have been shown to not help, actually.
Mm-hmm.
The countries that don't engage in the IMF programs tend to do better than the ones that engage in the IMF programs.
Mm-hmm.
So that's in a nutshell. The so-called IMF bailouts aren't that good a deal. They actually turn out to be a bad deal. As far as global goes, we're talked about inflation, and inflation is in fact a local phenomenon. This is something that comes up in the press too. The press is always talking about that inflation is somehow global. Well, inflation is happening in many places because they're following the same kind of policies as the Federal Reserve. That's if you look at Europe or the United Kingdom, they basically followed the Fed when the COVID pandemic started in 2020, and they started creating a lot of excess money, and a lot of inflation followed. But that's Europe, that's the UK, and that's the United States. If you look at other places, for example, like China did not do this. They followed more the monetarist approach. What's their inflation rate? 0.2% in China. So it's the second biggest economy, and they essentially have no inflation right now in China. So what's this global? What's global mean? Or you look at India, and India's inflation rate is about the same as the United States, but it's been lower throughout this whole COVID period. It's 4.3% India. United Kingdom, it's higher, 8.7. Switzerland has always been much lower. Their inflation rate is 2.2%. So the idea that inflation is global is just nonsense. You have to look at the local money supplies.
Yes.
Figure out what the prospects are for inflation given what's going on with the money supply in each one of these individual countries.
Exactly right. For them to say it's global, it just follows their narrative, as they don't look at the money supply as the cause of inflation. So excellent points there, Professor. I want to talk about this great article that you wrote it was on Fortune magazine, about the COVID lockdowns as the biggest policy mistake in modern times. Excellent article. And I think it was so important. Could you tell us anything more about that research?
Well, actually last week, a book was published by the Institute for Economic Affairs in London that I co-authored with Jonas Herby and Lars Jonig, and what we did, we looked at the relationship between lockdowns and the severity of different kinds of lockdowns and mortality, and we looked at it was called it's a meta, what they call a meta analysis, where you look at all the literature. So we looked at initially about 20,000 studies and came down ultimately to 22 studies that were sophisticated, could be normalized so we could actually compare the results and use them. And we found that the lockdowns had basically a tiny effect on health and mortality. And we already know the damage that was caused. The lockdowns, if you lock down the economy, we know GDP goes down, but schools were locked down, and we know education takes a hit. We know now that there were huge psychological repercussions and health damages associated with those lockdowns. So the number of lives saved by lockdowns, just to put it into context, were very small in relationship to the number of deaths annually as a result of normal flu. So that's when I say that lockdowns didn't do very much. I mean, we have many more people by a large factor that die of flu every year relative to the number that were actually saved due to the lockdowns. So that's why the conclusion of that book, which, by the way, happens to be a book that you can obtain free online from the Institute for Economic Affairs in London. That conclusion of our study, which I think is the most thorough one that's actually been done on lockdowns, is that lockdowns were probably the biggest public policy blunder in modern times. We've just never had anything like this happen before, where you had these enormous costs and really tiny benefits.
Yes, thank you so much for spreading awareness and bringing the reality of that. There's so many repercussions, negative repercussions that are in all elements of business, life, that are going to last probably for many years to come. And the psychological is terrible. Really sad what happened there. So thank you so much for everything, Professor. You're brilliant, amazing, and just want to spread the truth and realities of real economics. How can everyone follow you and stay in touch with you?
Well, I think the easiest thing is you can follow me on Twitter. I've got a big Twitter following. I think out of the Economist, it's and on a worldwide basis, it's number 3 at Steve _Hanke, Hanke. So
Perfect.
that's Twitter. You also can find my articles archived at the Independent Institute, independенtinstitute.org. And if people want to be added to my distribution list,
Yes.
if they can send me an email and just say that they've watched our interview and they request that I add them to my distribution, and that's just Hanke, Hanke at jhu.edu. And also the goal sentiment, you can go to that website that I mentioned earlier and find out all about that.
Absolutely. The goldsentimentreport.com. And we'll put all this information in the description. Thank you so much for speaking with us, Professor Hanke.
Great to be with you, Rosanna. Have a great day. See you.
You too. See you. Bye. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on The Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.